There's a battlefield of ideas about what money is, and the United States is uniquely positioned to dominate this race. But to understand how this fight will play out over digital currencies, we need to take a look at the ideas that will shape this confrontation. This story begins at a time when money in the United States worked quite differently than it does today.
So this is in the mid-1800s in the US, before the Civil War. A lot of banks issued their own private banknotes that were backed by state bonds. And the rules of those backing were a little different everywhere. And so you had many different banks with their own banknotes.
It's a system sometimes called free banking, and it resurfaces in Project 2025. That's a document published in 2023 by the conservative US think tank Heritage Foundation. And it's widely regarded as a blueprint for Donald Trump's second term in office. Out of the nearly 900 pages, only 12 address the Federal Reserve, yet they paint a picture of how the administration's thought leaders think about money. Private companies should be able to deal with currencies with as little government interference as possible. There's a strange connection between this 19th century idea and today's world. For years, the crypto world has expanded as a speculative asset class. Buyers of digital tokens could profit if they later sold them at a higher price. But when it comes to making payments in crypto, it helps to have something that holds its value more steadily. And that's where stablecoins come in. They are crypto tokens issued by private companies. For each coin minted, the issuer deposits an equivalent amount of US dollars or government bonds into a bank account to maintain a one-to-one peg. Like in the free banking era with stablecoins, private companies issue a form of money.
So the key question or the key concern from free banking era is that privately issued money may not respect singularity or singleness, which is that a dollar is seen as being worth the same by everybody.
And this singleness came under threat. For example, when somebody took a note issued by the Bank of Tennessee to Philadelphia, its price wouldn't be the same at all times. Similarly today, stablecoins aim to be stable in their price, but the market can test that commitment to a one-to-one peg, because the crypto tokens just don't have the same public backing yet as currency does. To begin to solve that problem, in July 2025, the United States passed its first ever law to regulate stablecoins. It sets out, for example, which assets stablecoin issuers have to hold as collateral.
US dollar-backed stablecoins collateralized with treasury bills could create a substantial new buyer for US treasury bills, and I think equally as important, it can lock in dollar dominance. Over history, there's been a series of events that have kept the US as a reserve currency, and I think passing this important stablecoin legislation could be that event for the 2020s.
People around the world now use stablecoins to send money internationally. In Turkey, where inflation is rampant and exchange rates unstable, stablecoins provide ordinary people with a simple way to obtain dollar-like assets on the internet. In Latin America, stablecoin usage amounts to nearly 8% of GDP. And the more people buy dollar-backed stablecoins, the more money globally is pumped into the dollar.
And the more the world saves in dollars, the cheaper it will be for the US government to fund itself. And that's what's called, exorbitant privilege. It's sort of a financial superpower. And stablecoins are going to really help with that if they do take off.
It's one of those battlefields of money that will play out in the future. But to dig deeper into how that confrontation will play out, we need to get back to its ideological base. Project 2025 establishes that a free banking system, one in which only private companies interact with each other, would make it possible to abolish the Federal Reserve, the bank that has the blessing of the government. But if abolishing it is unfeasible, the blueprint suggests other actions. One in particular stands out. To get there, let's briefly recap how banking works. So let's say someone says,
I need a loan and I need it in dollars. And the bank says, okay, here's your loan, here's your dollars. How do they do that? They put two entries on their balance sheet. One is the loan, which is an asset of the bank, okay? And it's an asset because the company is going to be paying them over the next 5 years, let's say. But at the same time, they create a liability, which is a deposit account, which means the company, their client, can spend, can transfer to another bank, to anybody. This is creation of money from thin air, okay?
It's a pretty good system. It's flexible and it leaves the day-to-day business to private banks, while the central bank handles higher-level matters. But if that system gets stretched...
Well, how does a thing like this ever start? All I know is the bank called our loan.
If there's a bank run, a panic, what happens to a bank if everyone wants their deposits at the same time?
Are they just going to go bankrupt and go away? Oh, that would be bad, because this is the infrastructure of our whole market economy. So the central bank, it can step in and do its own alchemy on its own balance sheet. You know, that's what lender of last resort is making loans to banks, exactly that same way that I just talked to you about, but at a higher level in the system, okay? So that it solves the problems that's lower level in the system, because the liability of the central bank is better money than the liability of a commercial bank.
Being loans, the money created during a lender of last resort operation is repaid once the term ends, removing all of the balance sheet entries in the process. Project 2025 suggests limiting that function, arguing its excessive use in the past led to reckless lending by banks. But curtailing that function could have ramifications worldwide. To understand how this will shape financial battlegrounds of the future, we need to travel back in time. This part of the story starts in the 1940s in London. The city had experience managing international money because it had run the colonial pound system. But after the British currency lost its global reach, bankers shifted to running a similar system with dollars. And that system works just like it does within the United States. When a company goes to a bank in London for a dollar loan, the same balance sheet mechanics that occur inside the United States take place there, and today in other financial centers worldwide as well.
And it's creation of money of dollars offshore that has nothing whatsoever to do with the Fed or the Treasury or any American bank.
The thing is, today this offshore world is much bigger than the onshore dollar world. US and non-US banks have increased the amount of dollars they book outside of the US that is offshore massively over time. For example, this offshore world includes a loan from a London bank to a Brazilian company, or US dollar bonds issued by a Korean firm and now held by a company in Singapore. The immense domain of offshore money is what makes the dollar special and a key aspect of its dominance. No other currency rivals it in this regard. But what if an offshore actor faces the same problem as onshore, a panic? A bank in London can't turn to the US central bank for a lender of last resort backstop.
How much do you need?
On the eve of the global financial crisis, then Fed Chair Ben Bernanke called the Federal Reserve's decision-making body for an extraordinary meeting. Since the summer, European banks had begun facing difficulties with their offshore dollars, and he wanted his colleagues' approval for a new tool. Bernanke wanted the Fed to be able to help out offshore as it would onshore. The idea was that the Fed would create additional dollars, the European Central Bank would create additional euros, the two central banks would swap them, and the ECB would lend those dollars on to European banks in dire need. Since then, the so-called swap line network has stabilized large parts of the offshore dollar market by acting as an international lender of last resort. But only a select few central banks enjoy this backing on a permanent basis. Since 2008, the volume of US assets circulating outside of the United States has grown, and offshore markets backstopped by those Federal Reserve swap lines have seen a notable rise in US financial assets. At the onset of the COVID pandemic, these global markets once again panicked. As markets froze in March, again a form of singleness came under threat. Onshore and offshore dollars were deviating in price from each other. And the Fed again backstopped offshore dollar markets, cooperating with some central banks of politically aligned countries temporarily, while maintaining unlimited support through select central banks picked by the Federal Reserve. But two major offshore dollar markets never received a dollar swap line, China and Taiwan, likely for political reasons. This means the US decides which dollar markets it will backstop and which it will not. That is the privilege and the burden of a global hegemon, keeping its options open both offshore and in the emerging digital battlefield of money.
If you run out of dollars, now you have a problem. You need to borrow from the Fed. You need to have a swap line from the Fed. Same for stablecoin. It's not magic.
Stablecoin issuers lack access to the Fed's lender of last resort support. They have to sell reserves to raise cash. But if everyone redeems at once, will buyers appear quickly enough? If not, the dollar peg could break, undermining the very stability and singleness of stablecoins.
Will there be somebody willing to take the opposite side of that trade in scale whenever needed? And I don't see why there would.
While Project 2025 doesn't explicitly mention crypto or stablecoins, the emerging stablecoin system may reflect its intellectual spirit. One significant proposal, however, is already in action. One of President Trump's first executive orders in January 2025 made the United States the only country to halt all work on developing a central bank-issued digital currency, a CBDC.
The US is clearly going for a private sector solution rather than a public sector solution. So alongside support for stablecoins, they also have an anti-CBDC act. So Europe and China have been innovating with central bank digital currencies, where central banks really are at the core of innovation for the future of payments.
Other central bankers are worried. The European Central Bank repeatedly issued warnings in 2025.
Stablecoins are privately issued and notably pose risks to monetary policy and financial stability. These assets are not always able to maintain their fixed value, compromising their usefulness as a means of payment and a store of value.
And even China, the US's main rival, is seeing significant inflows of dollars through stablecoins.
The access to dollar payments in parts of emerging markets was beginning to retreat. Now, stablecoins deal with a lot of those issues. They can be accessed by anybody. We also believe that China is potentially less able to compete as effectively in a stablecoin world because its capital account is more managed, because there is less RMB in the offshore universe.
The United States comes well prepared for this battlefield of money, strengthening the dominance of the dollar. Wielding the private power of stablecoin companies is very much in the spirit of the administration's masterminds, and they will continue to deny publicly backstopping this new money through a lender of last resort function. Until the moment arrives when it has to be there.